Hi, I'm Debbie Lewis and welcome to today's informational clip. What type of mortgage is right for you? You know, I've been in the money business for over 18 years doing mortgages, and it sure has changed in those 18 years. We've had subprime loans, we've had A paper, A minus paper, B paper, C paper. How do you know what's right for you? Well, there aren't as many choices now as there used to be. Most families are going to get a fixed rate mortgage. But there are still some adjustable rate mortgages out there, and there are some things called balloons. Well, we're going to talk about all that today. First, let's talk about how to choose the best mortgage. One of the mortgages that you can pick from is a fixed rate mortgage. That means that the payments are going to be fixed for the term of the loan. You can do a 10-year fixed mortgage, a 15-year fixed mortgage, a 20-year fixed mortgage, and even a 30-year fixed mortgage. Fixed mortgages are very conservative. They're always going to be the same. The only thing that's going to change with that regards to that payment is your insurance and your taxes. Those I'm sure are going to continually go up. But a fixed rate, at least the principal and interest, is going to remain the same. Also, as of now, the IRS does allow you to write off the principal interest payment on your homes. That's going to be subject to change with the government. The next type of loan you can get is something called an adjustable rate mortgage. Adjustable rate mortgages are usually connected to a LIBOR loan of some kind, and this is a way that the adjustment changes every month or every year depending on the kind of loan you get. Adjustable rate mortgages typically start at a low interest rate and then they can gradually go up. They used to have an introductory rate that was super low, and then by the first, second, or third year, they would adjust greatly. And that was part of the problem of 2008. People were caught with the wrong type of mortgages. Adjustable rate usually adjusts annually, but some do adjust monthly. You want to check into that. For an example, a typical ARM loan might have an annual cap of 2 percentage points, and that's over the life of the loan, so it doesn't go above a certain amount. Those are still risky, and if you can get a fixed rate mortgage, stick with those. The next thing you need to know about is a balloon mortgage. Now, a lot of smaller local banks do a balloon mortgage. That means that the mortgage is going to be due and payable at a certain time. It's usually a 5, 7, 10, or 15-year balloon. If you know you're going to be moving in 5 to 7 years and you'd like a lower interest rate but are uncomfortable with an adjustable rate, the balloon mortgage could be for you. This is also, sometimes if you get a construction loan, you get a balloon mortgage. These loans often include a somewhat lower interest rate than a conventional 30-year mortgage, but the loan is going to be due in a shorter period of time. If you're still in the house at the end of the term, you're going to have to find another mortgage and refinance out of it. That's why right now a 30-year fixed rate loan is the safest, with interest rates only headed up. Jumbo loans. Now, a jumbo loan is anything as of this recording date in 2016, 417 and above. So if you need a mortgage for more than $417,000, you're going to need a jumbo loan. Jumbo loans are a little bit harder to qualify for, and yes, you have to have a lot higher income to qualify, and those may or may not be for 30 years. They could be 15 or 10. Be careful of those jumbo loans because not every lender has them. Before you look for an interest rate, you need to know what your credit is, and we're going to talk more about that in another upcoming clip. I'm Debbie Lewis, and if you have questions about mortgages, whether they're subprime or A minus or the balloon or a jumbo, please email me. My email address is debbie@debbielewisshow.com. I'm here to help.